In November 1910, some of the richest and most powerful men in America did something unusual. They boarded a private train car in secret. They used fake names. They told no one where they were going. Their destination? Jekyll Island, Georgia. For 9 days, they met behind closed doors. No press, no records, only first names. These men controlled roughly 1/4 of all the wealth in the United States. They weren't planning a crime. They were planning the future of American money. What they created was the Federal Reserve, the institution that today controls the dollar, interest rates, and indirectly, much of the world economy. Welcome to episode 2 of Money Socialism. In the last episode, we saw how the state took control of money. Today, we go inside the most powerful machine in that system. How do banks actually create money out of thin air? Why do central banks exist? And what does Roland Baader mean when he says that what we call modern banking is actually money socialism in disguise? Now let's take a look at how this system really works. Grab a cup of coffee and sit back. Most people believe banks work like this. Customers deposit money, banks lend it out, and keep a fraction in reserve in case depositors want their money back. This is partially true and deeply misleading. The reality of modern banking is more radical and more important to understand. When you deposit $1,000 in a commercial bank, the bank does not take that $1,000 and lend $900 of it to someone else. The bank takes your $1,000 as a reserve and lends out $9,000 that did not previously exist. This is fractional reserve banking. The bank is required to hold only a fraction, historically around 10%, though many central banks have reduced reserve requirements to 0, of its deposits as actual reserves. The rest it creates as new credit. Let that sit for a moment. Commercial banks create money, not by printing it, not by finding it, by making a loan entry in a ledger. When a bank issues a $100,000 mortgage, it does not transfer $100,000 from one account to another. It creates $100,000 in new purchasing power, backed by the borrower's promise to repay, and by the fraction of reserves the bank holds. The Bank of England confirmed this explicitly in a 2014 research paper. The reality of how money is created today differs from the description found in some economics textbooks. Whenever a bank makes a loan, it simultaneously creates a matching deposit in the borrower's bank account, thereby creating new money. This is not a conspiracy theory. It is how the system works. It is published by central banks themselves. Now here is the Austrian problem with this system. When banks create money through credit expansion, without that credit being backed by real savings, they are creating purchasing power out of nothing. This new purchasing power enters the economy and bids up prices of goods and assets. But it also sends a false signal to entrepreneurs. It looks like there is more real capital available than actually exists. Businesses borrow and invest in factories, in equipment, in real estate, as if the resources to complete these projects exist. Sometimes they do. Sometimes the credit expansion merely reflects genuine savings that have been pooled. But when credit expansion goes beyond real savings, as it does in a fractional reserve system, with a central bank actively encouraging borrowing, it creates what Mises called malinvestment. Investment that looks viable during the boom and reveals itself as a loss during the bust. Baader described this mechanism as the monetary machine that eats its own children. The boom creates the conditions for the bust, every time. The Bank of England, the world's first modern central bank, was founded in 1694, not to serve the public, not to stabilize the economy. It was created to lend money to the English government so it could finance a war against France. The deal was simple. A group of private investors lent £1.2 million to King William III at 8% interest. In return, they received the exclusive right to issue banknotes backed by government debt. From day one, the central bank was a partnership between a government that needed money it didn't have and bankers who wanted special privileges they couldn't earn in the free market. This same pattern repeated itself across the Western world over the next 2 centuries. The Banque de France, the Reichsbank, and eventually, after massive political resistance, the Federal Reserve in America. In November 1910, a small group of very powerful men took a secret trip. They left Hoboken, New Jersey in a private rail car under false names. Their destination was Jekyll Island, Georgia, a private resort owned by J.P. Morgan. Among the attendees were Senator Nelson Aldrich and representatives of the most influential banking interests of the era, J.P. Morgan, the Rockefeller family, and Kuhn, Loeb and Company. For 9 days, they met in complete secrecy. No press, no public record. Only first names were used. What were they doing there? They were drafting the basic framework for what would later become the Federal Reserve System, the Central Bank of the United States. This is not conspiracy theory. It is well-documented history. In the last episode, we saw how the state gradually took control of money. Today, we look at one of the most important moments in that process, the birth of the modern central banking system. With a central bank as backstop, commercial banks could lend more aggressively, knowing that if things went wrong, the Fed would step in. The government could run larger deficits, knowing the central bank could always buy its bonds. The Federal Reserve Act was passed in 1913. Woodrow Wilson signed it into law. Senator Aldrich, who had helped lead the effort, later expressed regret. Not that the Fed existed, but that its close connection to the big banking interests had become too obvious. The Fed was sold to the public as an independent institution serving the nation. In reality, its regional banks were owned by private commercial banks. Its profits, above a fixed dividend, went to the Treasury. This created a deep financial entanglement between the central bank and the government, one that has never been truly independent. As Baader would say, the central bank is the heart of monetary socialism. It is the central planning authority for the economy's most important asset, money. To fully understand Roland Baader's critique, we need to look at 3 core elements: what a central bank is, what it really controls, and what the consequences are. First, the central bank as a state-protected monopoly. The Federal Reserve is not a market institution. It was created by an act of Congress, given a legal monopoly over the dollar, and granted powers no private bank could ever have: the ability to create reserves, set interest rates, and regulate the banking system. In any other industry, a government-granted monopoly to a private group would be seen as a clear market distortion. Baader applied the same logic to money. A monopoly over the most important good in the economy, the unit in which all prices, savings, and contracts are denominated, is not neutral. It is the most powerful monopoly that exists. Second, the interest rate as central planning. The Federal Open Market Committee, 12 people who meet 8 times a year, sets the federal funds rate. This is the interest rate banks charge each other for overnight loans. In practice, it becomes the foundation for almost every other interest rate in the economy: mortgages, car loans, business credit, and treasury yields. Baader was very clear about what this means. The interest rate is the price of time, the premium borrowers pay to use resources today instead of waiting until they have saved them. In a free market, this price emerges naturally from the interaction of millions of savers and borrowers. When a small committee sets this price instead, by vote, by model, or by political pressure, it replaces dispersed market knowledge with centralized planning. This is central planning applied to the most important price in the economy, the price of time itself. The consequences follow the same logic. If the interest rate is set too low, you get an artificial boom followed by a bust. If it is set too high, investment is suppressed. There is no correct interest rate that 12 people in a room can reliably discover. The necessary information is spread across every saver, every entrepreneur, and every business in the economy. Only a free price system can coordinate it. Third, lender of last resort as moral hazard. The Fed's most powerful function is to act as a lender of last resort. When banks face a liquidity crisis, the Fed can step in with emergency lending to prevent collapse. This sounds stabilizing. In reality, it is one of the main reasons the system becomes increasingly reckless. Economists call this moral hazard. When banks know the Fed will bail them out if things go wrong, they have a strong incentive to take more risk, to lend more aggressively, hold less capital, and chase higher returns. Profits are private. Losses are socialized. Baader described this arrangement with his usual directness. The lender of last resort is a machine that privatizes gains and socializes losses, and calls it financial stability. The 2008 financial crisis was the largest demonstration of this principle in American history. Banks that had taken enormous risks in mortgage-backed securities, in leverage ratios that would have been unthinkable without the implicit Fed backstop, were bailed out at public expense. Not because they deserved rescue, because they had grown so large and the system had become so interconnected that their failure threatened to bring down institutions that had been more cautious. Baader had a word for this too. He called it the revenge of moral hazard, the moment when all the risk that was never properly priced, never properly disciplined, never allowed to fail, arrives simultaneously. Baader's critique is structural. A system in which banks can create money out of nothing, backed by a central bank that protects them from their own mistakes, under a state monopoly on currency, is not a free market with banking attached. It is a planned economy with a market facade. Profits are privatized. Losses are socialized. What do you think? Do you agree with Baader that this is money socialism, or do you see it differently? In the next episode, we go deeper into Geldsocialismus, into Baader's chapter on debt. Because if banking is the machine, debt is the fuel that powers it. See you next time.